Did you know over 15 million homeowners have taken out a home equity line of credit on their house? And a growing number of them are utilizing that HELOC, home equity line of credit, to buy more real estate. But the question is that financially risky? Or is it okay? Let's break that down. Hey, I'm Josh and I help homeowners and investors utilize smart financial tools to buy more real estate. Today we're talking about HELOCs, or a home equity line of credit, and whether or not it's a good financial resource to purchase more homes. Let's face it, if you're saving up for a down payment, especially on a new investment property, you're gonna need anywhere from 15 to 25%. If you're looking to grow your real estate portfolio, saving that up house over house can be quite the long-term effort. This is why some buyers are utilizing smart financial tools like a home equity line of credit to gain access to that actual down payment, utilizing the equity they've already built in any of their properties. A HELOC can give you access to fast and flexible cash to utilize on your next purchase. But the big question is, does it actually make sense to do that? First and foremost, what is a HELOC? A HELOC is a home equity line of credit, and you have to think of it as like a credit line or like a credit card attached to the equity you have in your house. Typically, home equity line of credits will allow you to access anywhere from 70% all the way up to some 90 and 95% of your equity, depending on the type of property you're looking to open up a HELOC on. HELOCs allow you to pull out the money when you need them and only pay for what you utilize. And so if you have a HELOC of $100,000 and you only take out 20, 30, 40, you're only having to pay a monthly payment back based on that amount that you've actually taken instead of the full line of $100,000. Some of the benefits of a HELOC include access to fast, flexible cash. There are some lenders that will close in as little as 5 to 7 days on a HELOC depending on the property. Another benefit is you're gaining access to that equity to utilize when you need it and only pay back what you utilize. These programs also give you the option to have lower monthly payments based on just only paying certain interest-only payments during a draw period. And a draw period means typically with a home equity line of credit, you're gonna have a 20 or 30 year amortized loan, but you're gonna have between 3 and 5 years to draw those funds. So if you have a $100,000 HELOC or home equity line of credit, your draw period is 3 years. You have 3 years to take out the full $100,000, but every time that you take out more, your payment's only gonna be based off of the 20 or 30 year loan that it's amortized out to. So you have that option to take all the way up to $100,000 for that first 3 years, but then afterwards, depending on how much you take, it converts to a full mortgage, second mortgage, home equity mortgage that is amortized and gives you a monthly payment based on the 20 or 30 amortized year. Some of the downsides of a home equity line of credit though is one, you're tapping into the equity that you've already created. You've paid down that mortgage time over time and you are tapping into that equity, which is going to eat into what you already have if you decide to sell or refinance later down the road. The other downside is now you're managing 2 mortgage payments. Yeah, you're gonna have a mortgage payment on this home equity line of credit on top of the first mortgage payment if you don't have a paid off property, and you're gonna have to manage both of those payments. How does this compare to traditional financing? Typically, if you go to take out cash out or to refinance your mortgage to get a lower rate, you're refinancing your first mortgage. So you're refinancing and changing your interest rate, maybe taking out some equity, and all of your monthly payment based on what you've been paying is going to change depending on what your new loan amount is going to be. A home equity line of credit is a second mortgage. That means that your first mortgage is not going to be affected. You're going to have a new interest rate and a new monthly payment based on the second mortgage. So you'll pay the first mortgage that is not going to change, and then you'll have the second mortgage that will be completely different from that first mortgage. Now, some of the benefits of utilizing this HELOC to buy a house is you can utilize the home equity line of credit or the funds that you have as a full down payment and to cover any closing costs associated to the property. You could buy a new primary residence and rent out the one that you have that you opened up a HELOC for. You could buy a second home in a different state or the same state that you're living in and utilize that HELOC as the down payment source. Or you could buy an investment property utilizing the HELOC funds to fund the down payment on that. Now, keep in mind, you're going to have to qualify for all of these payments altogether. So if you retain your primary and buy a secondary or investment, you're going to have to make sure you can qualify for the first mortgage on your primary and the home equity line of credit and the mortgage payment that is going to be due on the new house that you end up purchasing, whether it be second home or investment or another primary. So you have to make sure, working with your lender, working with your agent, to ensure that you actually qualify for all of those payments lumped together. Now, one of the benefits here is, let's say you have a primary residence and you decide you want to buy a new primary residence and you've opened up a HELOC on the one you're living in and decide to rent out that house, you can actually utilize those rents to help offset the monthly payment between the first mortgage and the HELOC that you have opened. So there's a lot of different strategies involved when actually opening up a HELOC to buy a new property. Work with your lender, such as myself, to communicate and understand that process as a whole. So in essence, the biggest drawback to this is you have to make sure you're comfortable making all of the monthly payments if you're going to utilize a HELOC to buy a new property. It's not necessarily a smart thing, but it's also not a bad thing in order to take out new debt to buy new property. It depends on your current situation and the property that you're going to end up purchasing. Especially if you're just buying an investment property to refinance or put on Airbnb, maybe that property is going to offer you more returns to cover your first mortgage and your second mortgage HELOC and that third mortgage that you've actually opened on that property. Now, this could be applicable to your fifth, sixth, seventh, eighth property, whatever it may be. So as you can see, there's a lot of benefits to opening up a home equity line of credit and gaining access to that capital fast in order to reinvest back into real estate. What do you think? Would you ever open up a home equity line of credit on your current primary or secondary or investment property? Drop a comment down below. If this video was helpful, please like and subscribe. Thank you so much for watching. I'll catch you on the next one.